Hey everybody, Marty Mazur, good morning, 27th of February 2016. Wanted to take you through the charts again in this week's update. We'll look at a little longer term chart to begin with, and I want to talk a little bit about oil and high yield bonds and introduce you to another indicator that I think is interesting these days. So, folks, in front of you on the screen is the current bull market. Market bottomed back in March of 2009, S&P 500. And you can see we've been living in this long up cycle ever since, which we remain in. So I know we've seen some real weakness in the market. As you can see over here, you're hearing talks of bear markets and so on. But by definition, we are still in a up channel or up cycle, or we're still in a long-term bull market. We are definitely experiencing a downtrend within the longer-term uptrend. I think you could say right now that we're in an intermediate or a short-term uptrend and an intermediate downtrend, but maybe we'll go there as I dig a little deeper on the charts. The two lines, the yellow is the 200-day moving average of the prices of the S&P 500. The brown line is the 50-day moving average. Good things tend to happen when the 50-day stays above the 200-day. That shows you that the nearer term momentum of the market is to the upside. You could see during the correction, the last real correction we had, it was about 19% from peak to trough in 2011, was accompanied by a crossover where the 50-day crossed below the 200-day, which would be a bearish signal. And then you can see it made its way back above it and then stayed above it all the way until mid to late, the third quarter of last year, August, when it broke down. And then we got a very short-term correction. It was unsatisfying to me because I like corrections to last a little longer. They tend to do some good if they last longer, but we came right back up. And so, as I said a million times back then, it was meaningless to me. And then we came right back down, and it was also signaled by just a little short trip above the 200-day moving average for the 50-day and then back below. And here we sit currently. So, folks, we're definitely in a downtrend. We remain in a downtrend. We're not seeing these two converge at all at the moment. And so let's dig a little deeper. Let's just take a look at the one-year chart for a second. I don't know that there's much here to show you. Now I'll just jump to the 60-day. Okay, so this is the one you're used to seeing. I clean it up just a little bit here. No, I think it's okay. So we've done this already. We talked about here the market was oversold, ready to bounce. We got some short covering, got some money that was probably waiting for an opportunity to come in. Came all the way up, tested the 50-day retracement, retracing this decline that began on December 29th. All the way down, 50% tends to be a strong resistance level, as does the 38 and the 62. All of them, except for the 62, have had some meaning during this this attempt to come back from this pretty noticeable correction here. And Thursday we shot above it, and Friday we stayed above what I've identified as that 50% retracement level, which is short-term maybe bullish, like this one was here. Here I prepared you for a short-term bounce. We got it, but then found resistance right against that, came back down. With oil, we turned back up, and so here we sit going into next week. It'll be very interesting to see what happens. If you look at, if you consider this trend, against the 2011 trend, it's not quite as bullish as it was coming out of 2011. In fact, since I'm talking about it, let's just see if we can identify it here. Well, what does that? Here we go. Let's do this. Okay, so the 2011 bear market, or it wasn't a bear market, almost a 20% decline, came down and then found a lower low that would have been considered bearish, then came back up and then had a higher low, so to speak, and then came into a higher high. We had our correction back in August, came back down, looked similar to this, came back up, came down, and right here was threatening, kind of like 2011, but then broke down and made a lower low. So the intermediate trend is certainly to the downside and doesn't look quite as favorable here. Now you can, I think some people are now basically ignoring the August and then just really taking a look at what's happening right now more currently, and then maybe this looks a little bit more like 2011. But folks, things don't necessarily have to repeat themselves. We can talk about technicals all day long, which are important, and they do give us signals in terms of what's happening in the outside world, maybe before we might otherwise know. But I still think there's potential risk to the downside, and it would make great sense to me to see us penetrate down below these before we find a bottom later in the year, as I keep saying. We know the market is very correlated to oil, and so let's just go beyond what we normally do, and let's take a look at some other things. And speaking of oil, we'll do that. This is yeah. So let me pull this. Oops, I lost it. Hang on. Okay, so the price of oil, and this is a one-year chart. As we know, it's been declining quite measurably. We are in, I can draw trend lines, all over the place, but the more recent trend from last fall is just continuing this downward slide. Until recently, we've moved into what you would call a sideways channel, and we've kind of broken out of that trend here over the last few days. This is the 50-day moving average for the price of oil, and as you can see, we did get above that, although it didn't close above it, but did push above it. That might be viewed as resistance to some people. But the fact that we're pushing up against it now, it's going to, of course, slope down to catch up with us, but if the market moves above it, then suddenly that becomes somewhat of a bullish indicator for oil. But I want to introduce you to another one, what's called, what technicians call the MACD, M-A-C-D, or moving average convergence divergence. Let's see something. There it is. I want to move this one out of the way real quick and then draw a shorter term trend line, which I already did. I just want to now bring it over and put that right there. So that's the trend for oil prices since the beginning of the year. The MACD, the moving average convergence divergence chart down below, though, is showing a different looking trend. So folks, that can be a pretty strong indicator that the downward momentum in oil is losing its steam, and in fact, a turn might be in the near term offing. I mean, a meaningful turn to the upside. Now, these are just the technicals. You're going to hear more about OPEC and supply and this and that, but the technicals are interesting because, again, it's the market anticipating things that sometimes we may not. It can be anticipating things that we wouldn't otherwise see. Now, this MACD, moving average convergence divergence, what it does is it takes two relatively short-term moving averages, and this white line shows the difference between the two. When the shorter-term one is accelerating, this moves higher. Okay, this red line is the 9-day moving average of the answer of what the difference is between the other two. It gets kind of complicated to explain, but this is a signal line. Typically, technicians would tell you when the red or when the white line crosses below the red line, that's a sell signal. When it goes above the red line, that's a buy signal. And you can see it hasn't been a bad signal here for the price of oil. But when the trend is higher, when the price trend goes one direction and the MACD trend goes in another, and it starts from an extreme, that can be a pretty good indicator that there's something brewing under the surface that actually could lead to higher oil prices. And now this zero line is key. A lot of good, thoughtful, careful traders will not buy that or not believe that there's something afoot until this crosses above the zero line. So we want to look for that. I'm not, buying or selling oil based on this, I can tell you right now. But reason I'm looking to oil is because as we've seen of late, there's that very strong correlation between stocks and oil. So I want to look at oil and see what's going on under the surface. And at least from a technical standpoint, there's some promise that oil may be set up to begin to move higher. Now, don't hold me to that. The OPEC and Russia meet in March, and if they disagree on the terms of this output freeze, and they just basically come back and say what they've been saying for the last year plus, and that is we're going to let the market determine the price. Well, when you look at the demand versus supply, I think it is beginning to close together, but we're not there yet. You could see oil easily go back into as far as $20 a barrel. So this is telling us that the market expectations perhaps are something different than that, but it doesn't have to be right. That's just a signal that we haven't seen for a while when you go back and track these things. The other thing that has got the market worried, and in my written blog, I just made reference to certain financial indicators or financial market indicators showing potential stress and fears of recession. Well, the biggest one would be the high yield bonds or high yield credits. I've shown you many times a high yield credit spread, and that's the yield on high yield bonds versus a 10-year treasury. When investors are requiring more of subprime borrowers, people who borrow money to expand operations, businesses, the oil patch, for example, when the cost of those loans goes up, and it's gone up dramatically, that's a signal that there's some real stress in the economy, and it's been a good economic indicator for years. And so we pay attention to that one, and that one is flashing some real red signs or red flags. The chart you have in front of me, or in front of you, is the HYG, a very popular exchange traded index fund that tracks the high yield debt index. So it'd be the bonds themselves in this index, and it's investors buy it. You would want to buy HYG usually at the beginning of an expansion, but with all the stress in high yield, with yields going up, of course the prices have been falling. And I wanted to show you here the MACD line for the HYG is showing some support. Here we have three lows that are higher. These two are higher than this low. That is also a positive potential trend. You can see it is moving up dramatically. High yield credit spreads have come down and bonds have therefore gone up, and it's now exceeded its 50-day moving average. So the MACD may be telling us something about the high yield credit market. This is actually a bullish sign for stocks as well, and for the economy, because this is where the fear has lied. As we've been going down here, that means yields are going up, and that makes that other chart that I've shown you look somewhat ominous. The fact that that's turning, I think, speaks to this strength that we're beginning to potentially see in the price of oil, at least maybe for the outlook for oil. So folks, those are a couple of indicators that are beginning to signal, we haven't seen anything like this for a while, that perhaps we've got something better to talk about going forward. I can take the other side of that. I can point back to we can throw in more moving averages. We can see some real weakness, or I can even just go back to the 50 and the 200 and tell you that there's nothing here yet in this moving average slope that is at all bullish relative to other longer term averages and so on. So, I think you can make maybe just an equal case in either direction, let me put it that way. But it's been so long since we've been able to look at things, and I know I generally don't bring you this far into the weeds, but I'll say it as I say almost every time. I think the more I can help you understand some of the near-term dynamics of the market, the more perspective you have, the less nervous you might get about the market as it goes crazy. Because I still think that we may be sitting here and having closed this gap with the market selling off at some point. I just think there's so many headwinds. in my written commentary, I talked about strength in the and on the consumer side of the equation, that PCE, personal consumption expenditures deflator or price index, that's the Fed's preferred measure. That's moved up a bunch. Over the last year, it's moved up from just about 0 when you X out food and energy to 1.7 on an annual basis. So, folks, that's an indication that we do have some inflation on the horizon. And as the market gets more and more wind of that, if manufacturing, as a couple of those indicators I showed you, does begin to improve, now I have to say the services flash PMI was concerning, and I showed you that on the written blog. But if we do start to see some improvement, then we are going to be right back in that negativity around when the Fed raises interest rates. Now, if the economy is strong enough and earnings improve, and if what I showed you about in the written blog about capital expenditures, if that continues to pick up, that's the makings of productivity gains. That's the making of better profits, and that's the making of a higher stock market as well. So, folks, I could probably ramble all weekend, but I'll just stop it there. I'd say the risk to the economy, for the economy, is probably to the upside. As I said, I think the economy is better than a lot of people think it is. I think I'm going to say the risk in the market is balanced on a near-term basis. Longer term, I'm very constructive on the stock market. In fact, I'm quite bullish for long-term investors who own good companies, who are willing to wait out the ups and downs. And let me just, I'm sorry, I said I was going to close, but let me just add one more thing. At these points on these charts where, for example, where the market bottomed here and came up a bunch, there were two sides to that trade. There was the buyer and there was the seller. There was the seller and the buyer and the seller, and so on and so forth. You may have noticed in the written blog that I said that the headline that said retail investors are dumping global stocks is a bullish indicator to me, obviously a contrary indicator. And I explained that the retail investor, or the individual investor, if they refer to him as a retail investor, is generally on the wrong side of the trade. And folks, that is forever the case. Individual investors left to their own devices tend to react to the headlines, to the news, and when it's good or bad. And they tend to just feed the smarter, not the smarter, but the more experienced, the institutional investor, who knows that down channels or down cycles are followed by up cycles, and they're followed by down cycles, and there's always someone there who misinterprets the news, or who basically exits or gives up on their time horizon, or someone. But there's always going to be somebody, particularly at these times, who are willing to give them their stocks, give them shares of stocks that unfortunately, the person may have actually bought up here. So that's always the plight of the individual investor. And I know I've illustrated and talked about that forever, but this is just another opportunity to tell you that times like these are not times to sell. I had two different clients in yesterday, in fact, in the office. Two of the reviews we did, it was quite interesting. One person asked, should I reduce my exposure to stocks? We talked about her relatively high exposure to stocks. The other one asked, should I increase my exposure to stocks? The answer to both was no, not at the moment. The answer to the one who said, should I decrease my exposure? And this is a person who's very comfortable with the market, was just asking the question. I said, no, that's a conversation we want to have at another time. Of course, that's a conversation we want to have up here, right? There's nothing wrong with selling stocks, but there's something wrong with selling them in theory when they've been down a bunch. We're presuming that down cycles are ultimately followed by up cycles. The other person was on the right track in that she was wondering, should I be buying stocks because of the opportunity? But the suggestion was, should I be buying above my target allocation? I actually am buying stocks for her, but it's because the market's down and she has less than her target. But there's not a huge purchase that we need to make. Her question really implied, should we go a bunch more into the market, because she basically understands that these are opportunities. And I said, no, because it didn't really sit with our plan for her, with her financial plan, with, the stage in life, need for income from the portfolio, those kinds of things that you consider. From a financial planning standpoint, I didn't want to see her add exposure above her target. I'll say it again, I was adding because the market went down and we're under the target. But other than that, I just thought that was interesting. One person asked one side of the, would have been on one side of the trade, the other person asked with regard to, the other side of the trade. And in both cases, the answer was no, but for different reasons. Folks, I know that was long. Thank you, as always, for enduring my rambling, and I'll talk to you again very soon. Take care.